Hi, Mike. Welcome to the Legacy Lounge.
Hey, Samir, thanks for having me.
We're really excited to have Mike France, who's the head of Intrepid Investment Management, a specialist investment manager focused on the energy sector. Mike, really glad you could join us.
Well, thanks for having me, Samir. I'm really looking forward to today's conversation.
Yeah, so I wanted to just jump right in and sort of talk about where the energy cycle is and what you're seeing relative to past cycles and where we are now.
Yeah, so I think the primary way to frame it is I think we're seeing one good capital discipline broadly, and that's something different than we saw in previous cycles. I think there's also very durable demand, so you've seen energy demand continue growing. The vast majority of that continues to be supplied by traditional oil and gas, and so it shows a continued need for material amounts of capital to meet that demand. And so it's been a pretty healthy cycle for investing. There's been a amount of capital that's kind of gone from oil and gas generally that's slowly starting to come back in as people have realized traditional oil and gas is here to stay.
So that shift and that change and that you know, evolution of the energy market, how is that affecting kind of the opportunity set that you're seeing and where you're focused?
So I think it's had a material impact in that I think we found very attractive opportunities, specifically in energy infrastructure, which is where we focus. The particular segment within energy infrastructure that we like is lower middle market. Partly a theme we've seen is that infrastructure funds have just gotten larger and larger, which means they're focusing on larger opportunities, and so it's left a real void in our mind in that kind of $100 million equity check and below is what we define kind of lower middle market. And so there's a need for funding of high quality infrastructure, and there's a lack of capital folks in that space, which usually generates attractive returns and good opportunities for us.
That's great. And so, in terms of how Intrepid and your team thinks about the opportunities, if you were to talk about your edge, what's the difference in what you do? Could you kind of go through that?
Sure. Yeah. So our firm structured as a traditional merchant bank, focused exclusively on energy. But what that means is we have two business segments. So we have the investing business, which is what I run, and then we have the advisory business, which is made up of almost 50 investment bankers who are covering the full energy value chain on a daily basis out talking to energy clients. And so the real advantage we get from that is real-time information flow across the full energy value chain. And then the other real advantage is that's a broad reach and network that we're able to take advantage of. So for a relatively small fund, we get a reach much larger than you would expect by being able to leverage relationships across the full energy value chain and across the platform.
No, that's really interesting, and that connection to the bank side is something that I want to think about a little bit more with you because I was curious about on the exit side. How does that impact how you think about exit as well when you're thinking about as you build an investment
Yeah.
towards that end goal?
No, I think that's a great point. I mean, I think it's one of the things that I think we do probably more so on the front end than I have in the past. When you have that relationship in-house right down the hall from you, as you're making an investment, you can go talk to an investment banker who may have sold an asset very similar to that recently and say, how did buyers think about this asset? What were the key criteria they were looking for? What did they not like about the asset you brought to market? And so we're really thinking about the exit and how to shape an investment on the front end. I think probably more so, like I said, than I ever have in my career by having that advantage right there in house.
So in the environment today, like when you look at like the public markets and the private markets and kind of this explosion in the private markets, how does that impact kind of your optionality in terms of that exit side? I mean, does it? You were describing how there
Yeah.
are these great big funds
Yeah.
now, and is that do those become like natural partners in some way on either side of the transaction?
They do. And so the IPO market doesn't really impact us at our size. I mean, we're, again, sub 100 million. We're typically an asset sale to either a strategic who's in the area who can acquire us as a bolt-on pretty easily, or as we get scale, we become an attractive platform for those larger infrastructure funds. So to your point, I think we're doing kind of the smaller blocking and tackling, getting it to scale, building a platform, and then we're an attractive asset or company that those larger funds can acquire and kind of take it to the next stage of growth with incremental capital.
Oh, that's great. So I would maybe step back because I wanted to get to your background a little bit and where you've seen all of these different cycles and in different, from different vantage points, and
Yeah.
getting to your background of kind of what does this cycle look like versus others? What are some differences that you see versus prior cycles, and sort of what you did and what you've learned
Yeah.
in that journey?
No. So I've spent over 25 years in energy finance, almost 20 of that now in principal investing in energy. Prior firm, we were looking at much larger opportunities. And so at Intrepid, we're now looking at, again, sub $100 million equity check investments. And so through that experience set, I've looked at deals of various sizes, but also at all segments of the energy value chain. And through that cycle, some lessons learned have been what we're looking at is reducing or no direct commodity exposure. We like looking at assets that are truly contracted cash flows, look at real downside protection through that contracted cash flow that gives us a base set of distribution floor and then growth to the upside. And so when we think about that set of assets in the current cycle, that's why I like that sort of stability. I like the consistent demand growth and commodity within a reasonable band. And so when you look at past cycles, you didn't have that same disciplined CapEx, which is what really created the kind of boom and bust of significant growth, too much funding, overgrowth, a lag. Now there's appears to be a lot more stability in the overall cycle and narrowness of the band of which you see the spikes in commodity that's resulted in, I think, good consistent growth, but also the ability to find nice long-term contracted assets with good cash flow.
So this kind of leads to two questions in my mind. One is you now have in principal investing been sort of in the boardroom or on the operating side. What have you seen that maybe doesn't come out on the spreadsheet, right? What are some of the lessons or the opportunities that you realize, oh, as an operator, I really understand this better than maybe as an investor, as an investment banker?
Yeah, no, it's a great point to raise because what you see so I think at this point I've been on the board of about 20 public and private energy companies, and one of the things you really learn sitting in the boardroom thinking about kind of the strategy and what's next is how critical the management team is to the overall investment. And so I mentioned a number of the criteria we look for, and I certainly should have also mentioned partnering with world-class management teams. And so their expertise, their ability day to day to drive not just the basic operating principles of the business, but help you think about strategy, think about most efficient operations, keeping costs down. And so having a world-class management team who's spent their entire career in that segment of the market is certainly a critical part of making good investments.
Yeah, no, and I think that experience is somewhat different than what we see from other managers where they're thinking much more about from the investment side and from a cycle perspective. And so I think the other side of this is the understanding of how does this impact how is it impacted by the cycle? Because I think the investment cycle, prior to this, I'm curious why you're not seeing the same look into these contracted cash flows. It used to be a lot more, it feels like, about the commodity,
Yeah.
about more upstream versus downstream. So what do you think is different this time that's giving these opportunities or allowing these opportunities to be there for you?
Yeah. No, I agree. I mean, I think a fundamental theme you'll hear from us is, and I think a misconception people have of investing in energy, oil, and gas is it's a bet on commodity price, and that's certainly not where we're focused and where we're playing. And I think part of it is that capital discipline has kept commodity, I think, in a fairly reasonable band. And so by being in that reasonable band, people can start making more long-term capital decisions, which also can result in people willing to sign longer-term contracts. And so I think all of that is there feels to be a bit more discipline and stability in the market that allows people to start thinking a little bit longer term. And then why we're finding these opportunities, again, I think is focusing in that sort of lower middle market segments, a little underserved.
Yeah, that's great. And I think maybe let's just jump into some of the opportunities that you have looked at over the last few years and what those look like, and maybe start with start with one, and then maybe we'll go to some of the others.
Sure, sure. So, within our existing portfolio, we have a combination of pipeline assets, terminals, and the logistics assets around that is a segment we really like. We're in a contract compression business. We're looking at a current midstream pipeline business.
And when you say contract compression business, we have probably a lot of folks that aren't deep in the energy patches as everyone else. So maybe describe a little bit of what that compression business looks like.
So that's deploying large horsepower natural gas compressors that will be part of a pipeline system that effectively compresses the natural gas and sends it through the pipeline.
Okay.
So it's a key part of the infrastructure when you think about the pipeline. And so those also have a nice contracted cash flow nature to them. The market there has shifted to longer term contracts. Those are typically 3-year contracts with consistent renewals because it's a critical component of the production part. So after a well is producing, sending natural gas through the pipeline is a key part of generating revenue and needing that compressor there on site. And so when I think about those different segments we invest in through pipeline, terminals, and compressors, contract compression, a theme across all those is contracted cash flows, high quality assets that are critical infrastructure to the ultimate customer. And so if I take the crude oil pipeline that we own in North Texas, an example, it's relatively small asset, and I say relatively, it's a sub $10 million type asset that you would think is relatively small. So who's your counterparty? Our counterparty on that business is a large multinational investment grade business, and so. And it's a critical component of taking volumes from one part of their value chain up to a refinery on the other end of this pipeline. So it's a very critical piece of infrastructure for a high quality counterparty who's contracting all of the capacity. And so it's just an asset that we can run more efficiently because it's smaller and can do it at lower costs, which is what generates the opportunity for us.
So how do you balance that idea of, you buy something that's already got the contracted revenue, but then you're looking for growth as well? How do you build upon that? I mean, do you actually have, is it growth of actually the assets, or is it you're able to create more efficiency with the assets that you buy?
So it's a mix, and I think what we try to do in our portfolio is have a balance of assets that I would call more just yield oriented versus growth, and some are a mix of both. And so in that specific example on the pipeline, it's more of a yield opportunity. It's one that we thought we could generate more cash flow than the day we bought it by just cutting costs. So that was more of you knew your fixed revenue. Can you reduce expenses enough to generate more free cash flow to generate greater return? And that's what we're able to do on that one. In our Gulf Coast terminal business, that one's a great example of it's a mix. So when we acquired that asset, about 20% of it was being utilized today. We took out that capacity under a long-term contract that generated a really nice base return for us. So think kind of low double-digit yield, and then significant growth capital to add incremental capacity to an already built-out facility. It's really refurbing the additional capacity as the growth CapEx. And so I think that's a good example of taking what was an underutilized asset. It was mission critical infrastructure to the existing owner. And so we acquired that piece of infrastructure, took out a long-term contract with the seller, and then now we're spending growth capital to keep adding additional third-party customers. So we're taking a proprietary facility, turning into a third-party terminal on the back of a long-term contract. So I think that's a great example of kind of a mix of both, because we have long-term contract to generate some yield, but real growth CapEx to grow the business.
And in terms of some of these assets, they're primarily maybe either oil or they're gas, or are they mixed use? Can you use them for other purposes? Can you bolt on to what they're doing, or kind of how does that work from the types of assets that you're buying?
Certainly, yeah, you certainly can. So one of the things we really like about the terminal space, and if I go back to this Gulf Coast terminal example, we can store almost any type of product. So we store specialty chemicals, we store refined products, so diesel, gasoline. We're talking to customers about storing additional specialty products, talking about crude oil. So it could be a mix of any product, as long as you have the logistics infrastructure that allows you to transport all of it, which this facility does. And so we have barge docks, we have rail racks, we have truck racks, you have pipelines that allow you to bring any type of product in through any of those modes to service your customer. And so we like assets that have that optionality to move various products and through various modes of transport.
And this is a little bit of a turn in a different direction, but does the geopolitical sort of flows and geopolitical movement, has it changed in the last, let's say, 3, 5, 10 years, and is it affecting you in any way in terms of what you're seeing in terms of flow, demand, and movement of product?
It certainly does. And so you can take an example of there's an asset that we owned, or that we do own in Joliet, so just south of Chicago. That facility was built around a theme of Canadian crude being imported in by rail. That business has since gone away because the geopolitical modes of commodity coming in have changed, and so that facility had to be repurposed. And so now it's bringing in product via pipeline. It's going direct to refineries, and so you certainly want assets that have that optionality to be able to pivot if there is a change in modes. And so that's one example. Certainly you had the geopolitical, the tariffs, and how could that have impacted product. Luckily, none of our businesses were very materially impacted by that. I mean, the contract compression business had some components that may have had an impact, but most of that business, you can flow that incremental cost through to the customer and rates over time. So, but yes, it certainly need to be in assets that have optionality. And again, if you're in high quality assets that are in the right local demand centers where has growth around that terminal or asset, you're positioned right to be able to pivot with those modes as the products change and come in through various transports.
No, that's great, because I think that's one of the things that thinking about this too in terms of the resiliency of what you're doing, it's not necessarily as economically sensitive as, let's say, going upstream. Is that fair?
Certainly, yeah. No, I think that's definitely right. I mean, all of our contracts on within the current portfolio are take-or-pay contracts, which effectively means the customer's paying you for that capacity, whether they're using the storage or not. So a lot of times you'll find customers who want to know they have a certain amount of capacity to store product, whether volumes are up or down. They want certainty of capacity, and so they'll reserve a certain amount of capacity and pay you $1 per barrel to have that right to store product. And so it's not a direct volume flow or direct volume calculation. It's here's the amount of capacity I want to make sure I reserve. And so that take or pay contract eliminates a lot of that volatility and direct volume exposure.
So one theme that I'm sure you hear a lot about and we hear a lot about in the news is, of course, AI. And in that vein, we hear a lot of talk about energy and AI.
Yep.
And so how are you thinking about that? How are your assets impacted by that? And where are you kind of positioned in that, in what we're seeing in terms of excessive growth?
Yeah, no, and it's certainly providing some tailwinds to natural gas broadly, and so you're hearing that theme across the industry of expectation for continued demand growth and just natural gas broadly. And so how does that impact us? We're currently looking at an opportunity in South Texas that's buying an existing midstream system, but providing material growth capital for further build out. And a lot of that conversation has gone from typically it would be build out to take a product just to key demand markets. So it'd be taking natural gas from the wellhead to a delivery point that ultimately can get product to the Houston market or Corpus Christi market, where now there's new demand centers popping up by data centers being built. And so it's, well, how do I get natural gas from where you are to my data center to power those facilities? And so there's incremental need for infrastructure built just beyond your traditional demand centers because of the AI boom. And so we're certainly seeing it there. Our contract compression business is certainly being impacted. One, the more product that needs to be moved to different locations means more need for contract compression, but also those engines, which are Caterpillar engines, are also being impacted by the need for power generation at data centers as well, because those same engines can drive a lot of that power generation. And so you're seeing really knock-on effects at several parts of the energy industry and parts of the value chain.
Oh wow! No, that's something I think that is really, a trend that we didn't expect. I think,
I
or the
think that's definitely right.
from
Yes.
technology
That
and
is
the
exactly right.
connection of technology and energy.
That's
And I think
exactly
it's
right.
something that we it was not expected.
Yeah, no, and you're starting
Um,
to see it firsthand, and it's going to be a material need for additional capital. That's for sure.
and this notion of the middle market relative to the larger market, do you anticipate like trying to grow these businesses into sort of larger cap businesses? Like, what is kind of the way that you think about where you see? Do you want your middle market business to be a large market business, or is it you like to sort of stay in that middle market world?
Yeah, no, I think we do want to ultimately take that business up to a scale where it becomes interesting to a larger buyer universe. So we're at what I'm defining as even below middle market to lower middle market, and part of that is these are just much smaller deals than larger funds really can spend time focusing on because they have so much capital they're looking to deploy. And so a number of the opportunities that I've talked about as an example here are just deals that are too small for somebody who has to deploy billions of dollars of capital to spend time on. But for us, we can go in and acquire a terminal for a sub $20 million acquisition price, put another $20 to $30 million of capital behind it in growth projects, and then as that creates incremental value, now we're selling a hopefully couple hundred or few $100 million asset that now starts to be a platform for that larger fund to invest in. And so that's actually a key part of our theme is focusing on the lower segment of the market. The reason we like focusing in that segment of the market is it's a lot easier to go to a counterparty and just have a proprietary conversation on an asset of that size that they're willing to transact. It usually can be directly with an asset manager or somebody's part of running a particular division within that larger organization, has the authority to make the decision on a direct asset transaction of that size. When you start talking about businesses selling several $100 million assets, usually that goes to board level, executive level, then they have to run a full process. You have investment banks running a process, generates more competition, and we'd like to be the ones selling into that competition, not buying into it. And that's why we think kind of focusing on that lower middle market, we can utilize the network of relationships I mentioned earlier to get in front of counterparties and proprietarily negotiate some of these smaller transactions.
So that network too, that especially coming from the merchant side of the house, is that the primary source of deal flow, or where do you really see and find all this deal flow?
It is, yes. It's through our collective set of relationships across the firm. So a combination of the investing team and our network, but also being able to utilize relationships across the firm. And what I really like about that set of relationships is it helps us on every segment of a deal. So it's not just sourcing a deal, but even when we're doing due diligence on a deal. And so it's very rare that there's an asset we're looking at that somebody at our firm doesn't know somebody who somehow touched that particular opportunity, competed with it, operated in that same segment. And so I think it also gives us a competitive advantage when we're conducting due diligence. So we can bring in whether it's an operating partner, an experienced advisor, or utilize that relationship to find the right people to help us evaluate an opportunity. And then also, as we're growing the business, we can bring in independent advisors on the board. All of those can be people who are our people who we get access to through this broader network. So it helps us in every segment of an investment.
Oh, that's great. And I think one of the other things that's a general question that I always am curious about is how many deals do you see a year? I mean, at the end of it, it sounds like you only invest in a handful, but what's the flow look like? And so how does it filter down to you're making a decision?
So it's you have to cast a pretty wide net and have several steps through your investment process to work your way through that filter. So we'll see. I think last year when we looked at the stats, it was over 300 deals that came across. And I say came across, it came in and you quickly say, okay, that doesn't fit and move on. And so you have that first quick filter of, okay, is it in the segment we want to invest in within energy? Does it meet the criteria of, are there contracted cash flows? Who's the management teams? There's several key criteria you can use to quickly filter that 300 to 400 down to, the 50 that maybe we spend a little bit more time on. And then that's a little bit more time maybe, all right, we take some more materials, take a meeting, you dig in a little bit, and then how many of those actually go to where you present to the full investment committee to make decisions? That ends up being, that's probably the biggest haircut. From that 50, you take less than 10 to the committee, and at the end of the day, you end up doing 2 at the end of the year. And so 2 to 3 maybe in a year. And so you've got to, but to get to those 2 to 3, you look at several hundred for sure. And a lot of that deal flow is just through our, through the platform we have. I think see a lot of opportunities come across, but have to have with a lean team, have a pretty quick filter.
And then, once you've made that decision and you've started to put the capital to work, some comes from your pooled structure where you have a fund, but do you also rely on some of the sort of follow-on capital as well as you start to grow? Do investors provide that as well?
We do. Yeah, it's a very, very common theme that you're probably hearing and we're hearing across the investment landscape is investors like the opportunity to co-invest directly in deals as well. And so it's been a consistent offering across our portfolio. And in fact, of the existing was 5 investments in our existing fund, 4 of which have offered co-invest. It allows us to kind of scale up on opportunities, but also provide that incremental capital beyond just the fund. And so they'll either come in at sometimes as part of the original underwrite, or as the business starts to scale up and you see a need for incremental growth capital, we can go out to our existing relationships and raise incremental capital that way. And so, yes, it's a very common theme we're seeing across the industry and something that our investor base really likes.
Oh, that's great. So kind of tying all this together, if you were to give us the elevator pitch of what is Intrepid and what you would want somebody to come away learning about Intrepid, what would that sound like?
Yeah, so we're a energy-focused, lower middle market investment platform, focused exclusively on energy in the infrastructure space, and we're able to leverage a much broader platform than your typical fund of our size. And so that gives us what I'd say firepower and reach of a very large firm with a very unique set of relationships, but focused in what we think is an underserved lower middle market segment in energy infrastructure.
Oh, that's great. Well, thank you for joining us at the Legacy Lounge. This was really, really helpful, informative, and your insights were very valuable.
Great. Well, thanks for having me, Samir. Great to see you again.